On the morning of May 6, 2010, the U.S. stock market was having a bad day. The European debt crisis had markets spooked, and by early afternoon, things were down a couple of percent. But at 2:32 p.m., a mildly bad day turned into something completely alien. Looking at this chart, you can see the sheer absurdity of the collapse. Accenture, a global consulting firm, plummeted from $40 a share to exactly 1 cent in 7 seconds. Meanwhile, Apple stock violently glitched in the opposite direction, briefly trading at $100,000 a share. Then, just as quickly as it broke, it fixed itself. By 3 o'clock, the broad market had largely regained its massive losses. In exactly 36 minutes, $1 trillion of wealth was completely vaporized, and then magically materialized right back onto the books. While the financial world panicked, a British working-class trader named Navinder Singh Sarao was operating from his parents' bedroom in West London. He had actually logged off for the day at 2:40 p.m. local time, just 1 minute before the chaos peaked, raking in nearly $1 million in profit. It took years of investigation, but eventually the United States Department of Justice pointed a finger directly at him. They officially indicted Navinder, blaming this single retail trader for triggering one of the most violent collapses in stock market history. Navinder was absolutely breaking the law from that bedroom. However, the raw data reveals a much more uncomfortable truth. The U.S. government turned a retail trader into a scapegoat to avoid admitting to a massive systemic failure. By 2009, making money as a human trader was becoming intensely difficult. The financial ecosystem had been hijacked by high-frequency trading bots, powerful algorithms capable of executing millions of decisions in fractions of a second, leaving manual traders in the dust. These institutional bots were legally allowed to use a loophole called flash orders. Exchanges would charge a fee to show these algorithms the incoming buy and sell orders a few milliseconds before the rest of the public saw them, allowing the bots to skim tiny, guaranteed profits off the top of every human trade. Frustrated by losing his margins to robots, Navinder built his own automated countermeasure. He designed a custom program to execute a highly illegal strategy known as spoofing. Here is how his specific spoofing tactic, called layering, worked in the digital order book. Navinder's bot would place a few small, genuine trades in the center, and then immediately surround them by creating thousands of massive, fake orders at varying prices. The high-frequency bots would see this massive wall of sudden interest and react to it, artificially shifting the actual market price up or down. Once the price moved to where Navinder wanted it, his genuine trade would execute, and his software would instantly cancel all the fake orders before they could be fulfilled. On the day of the flash crash, Navinder ran this strategy hard. By midday, his software had injected roughly $200 million worth of fake trades into the market. But remember, he logged off at 2:40 p.m. local time. He wasn't even at his keyboard when the real drop happened. His cheat code certainly flooded the system with artificial volume, manipulating the price of futures contracts. But because he wasn't actively trading when the bottom fell out, the data points to something else actually pulling the trigger. The real catalyst arrived at exactly 2:32 p.m. when a massive mutual fund decided to offload 75,000 E-mini S&P futures contracts. That represents a total value of $4.1 billion. You cannot just dump an order that size onto the open market. The buy-side liquidity, meaning the available pool of willing buyers, was only around $3 billion. To avoid crashing the price, a trade like this has to be slowly tricked into the system over several hours using a carefully programmed sell algorithm. As we look at the logic of this specific algorithm, you can see a fatal flaw. The fund programmed it to execute based entirely on a target volume, specifically 9% of the trading volume from the previous minute. But they failed to attach any price or timing limits to the sell order. At the exact same time, high-frequency trading bots were aggressively buying and selling the exact same contracts back and forth with each other, holding them for mere milliseconds. They had no intention of keeping the assets, but their constant trading rapidly drove the overall volume metrics through the roof. The mutual fund's algorithm looked at this artificial metric and falsely assumed there was an endless pool of willing buyers. Acting exactly as it was coded to do, it accelerated its speed and blindly dumped the entire $4.1 billion into the market in just 20 minutes. This blind data dump overwhelmed the limited amount of actual buyers. The sheer weight of the sell-off crashed the futures market, and because financial systems are deeply interconnected, the panic instantly bled into the actual stock market, shattering prices across multiple exchanges. The flash crash was a catastrophic systems failure, the result of a poorly coded mutual fund algorithm colliding with an ecosystem saturated by hyperactive trading robots. The 36-minute freefall deeply embarrassed federal regulators. It exposed the reality that Wall Street's heavily automated, incredibly lucrative new ecosystem was tragically unstable. But you can't easily put lines of code in handcuffs, and the predatory practices of the high-frequency bots were technically legal at the time. The government desperately needed a human fall guy. They turned their full attention to Navinder. When the Department of Justice officially indicted him, they charged him with 22 counts of wire fraud and manipulation, carrying a maximum sentence of 380 years in federal prison. The crash did force some necessary regulatory updates. In the immediate aftermath, lawmakers passed the Dodd-Frank Act, which finally provided a direct legal definition for the crime of spoofing. Yet, threatening a lone retail trader with centuries behind bars for market manipulation felt wildly disproportionate, considering that massive financial institutions engaged in similar artificial volume tactics every single day. This aggressive prosecution also occurred just a few years after those same major financial institutions caused the 2008 global economic collapse, a crisis that resulted in virtually zero high-ranking executives facing jail time. Navinder Singh Sarao broke the rules to beat the algorithms at their own game, but his story ultimately highlights a much larger structural rot. He exploited a financial machine that Wall Street had engineered to move entirely too fast for its own good.